Everyone has to live somewhere, and everyone has to invest their money someplace. So what happens when where you live meets up with where your money is invested? Hello, real estate. Hey, everybody. Welcome back to Big Money Real Estate. I'm Ilyce Glink. The early summer home sales reports have been kind of a mixed bag, and I've been hearing some anxiety from people who are wondering whether the housing market recovery is actually going to stall out before ever reaching its stride or before getting back to where it was 10 years ago. And I'll be honest, I've been a little concerned myself. But my guest today doesn't seem too worried. Jonathan Smoke is the chief economist for Realtor.com, and he recently published an article in which he explains why the new low sales numbers from, or I should say the low new home sales numbers from the Commerce Department shouldn't really be much of a cause for concern. Now, Realtor.com also has a couple of new reports out on the 20 hottest housing markets and the 10 housing markets where it's easiest to buy a home around the country. So we're going to get the scoop on that as well from Jonathan. Jonathan, welcome to Big Money Real Estate.
Glad to be with you, Ilyce.
It's really nice to meet you and have you on the show. We got to know each other a little bit at the recent National Association of Real Estate Editors Conference in Miami. It was the first time I'd ever really heard you talk, and I thought you lit up the room.
Well, thank you. I'm a longtime fan of yours. I lived in Atlanta for 17 years, so I used to enjoy you on WSB, and I think our careers focusing on real estate have actually pretty much overlapped over the last 20 years or so.
I think so, and I can't believe I never had you on that show. So I'm making up for lost time. We'll do a double-length interview today. We'll just spend the rest of the afternoon here talking. I'm sure we probably can. So let's go to some of these new sales numbers. It looks like the month-over-months for new construction sales are up. In June, I'm sorry, that they were down in June, but they were way up in May. What's your take on what's really going on with new construction?
Yeah, the new construction data series, I just wrote a piece on Realtor.com last week about trying to make sense of some of these numbers that come out on a monthly basis that can be pretty confusing. When it comes to the new construction data, both the new home sales numbers that you were referring to and the permits and starts data, both of those are produced by the Commerce Department, and they're based on surveys. In the case of new home sales, the Commerce Department surveys what is a relatively small sample of builders each month, and as the new home market is now a much smaller market than it once was, that type of approach to producing the data is very prone to having revisions, and in fact having what is referred to statistically as a confidence interval that is very large, which if you read the fine print in the report, it essentially meant that that 7% down figure was not statistically significant. In other words, the headline should have been, "We really have no clue how June compared to May," which always leads me to really dig into what numbers can we really rely on. And so, for example, in that case, I pay attention to the non-seasonal numbers for each month so far this year. Interestingly, they also, as another kind of shout out to how noisy that series can be, they revised every monthly number going back to March in the release that we received last week. So when you look at the year-to-date numbers, new home sales are actually up 20% over last year, and that's way more consistent with other data points that we're seeing. So, for example, NAHB puts out a monthly builder sentiment index, and that's pretty much been at the highest levels it has been in nearly a decade. So seeing really strong sales would certainly make more sense in that light. And then national public builders have been reporting, of course, their quarterly earnings, and the news coming from them from a new orders perspective been generally very positive.
But let me jump in, because it strikes me that yes, the numbers are all looking really good, and sort of this year-over-year 20% increase is wonderful. But last year, we were still under 500,000 new homes sold, which is probably less than half of where we should be. We're now 8 years, or 6 years officially past the bottom of the recession. From March of 2009, we saw that's where the stock market really went to the bottom. So we might be over 500,000 new homes sold, but wouldn't you agree that we really, by this point in time particularly, should be over 1 million new homes sold a year?
We should at least probably be in the territory of 800,000 and trending towards a million if it were a typical recovery, and if the industry looked more like it historically has. But that's the issue. This hasn't been a normal recovery. This was a housing-induced recession that largely was a reflection of overbuilding and the industry itself, the home building industry. It looks incredibly different today than it did a decade ago. You have the share of new home sales that's controlled by the largest builders has grown over the years as their access to capital, especially for small, local, and regional builders, has evaporated.
Well, they've also bought each other up, right? You've got
Right.
a situation where I think it was Pulte merging with, who did they merge with at the bottom of the recession? The other really huge deal. Do you remember who it was?
So yeah, you had Del Webb
Del Webb.
during the peak that Pulte bought. You had multiple purchases and mergers. I myself was a part of a national builder that we went through huge growth in acquisitions.
Yeah.
So there's no question. And the stat that Metro Study, company that I used to work with, actually reported that in 2014. Over 60% of the closings nationally for new homes last year was controlled by the 200 largest builders in the country.
Right.
And that is phenomenal change in the structure of the business. And those larger builders are very disciplined. Most of the large ones are public, either publicly traded or they have public debt.
Yeah.
And as a result, they've been very much focused on profitability and smart growth. So you haven't seen the typical type of 40 to 50% increase in permits and starts so far, and I'm really skeptical that we ever will over the next several years at least.
So let me go back to something you said about this recession being the recovery being anything but normal. Let's go back to the prior recession, so 1999, 2000, 2001, and I'm sort of including 1999. It wasn't the recession then. That was still sort of the big expansion going to the pop, but you know, we did not see a normal recovery from that either. That was considered the first jobless recovery, and we talked about how this is really a housing-driven recession. I would argue that the growth was really financial services-based growth, where you were seeing the kind of ginning up of the money, super low interest rates, you know, that had started back in 1993 when interest rates fell for mortgages below 6% for the first time, maybe since World War II. And so you saw in 2001 when you started to have this big pop sort of from the West Coast. You had a lot of digital stuff. This is the early years of Google and all these other companies that said, we don't need to make money. We can just, I don't know what, live on air. But you saw that jobless recovery in the aughts, as it's called, and then we started with the building up of this housing bubble, and then we had the explosion of the housing bubble. And so now, since really 2001, in my view, and I'm only the armchair economist, you're the one with all the letters after your name, but wouldn't you agree that these two recessions back to back and the jobless recoveries have really driven a systematic change in the way that the economy works and how it's moving going forward?
Yes, I often refer to the fact that really the last 15 years haven't exactly been normal by any stretch of the imagination. So that really causes problems when you're trying to forecast what's going to happen next and how is this going to evolve. The period that you described, had the popping of the tech bubble and really capital was still very loose. And real estate suddenly became the hot place to go, and you can see that in the federal funds data, showing just how much debt ended up pouring into real estate, which of course led to the housing bubble and the enormous increase both in home prices and in sales. That effectively, I like to tell people in the industry that we really should have a lobotomy and forget about the years 2004 to 2006, because we're likely never going to see that sort of activity again.
Well, I hope we don't, because the price that we have paid as a country and as a world, we're still paying it 8 years later. And you could certainly argue that now with the international issues that we're seeing, where you've got functionally negative interest rates in Europe. We've got China's stock market well into bear territory. The country, the government's trying to prop that up. That doesn't seem to be working for many investors. So they're in a very serious situation. Latin America has slowed down. You know, you can argue that a lot of these problems around the world come from this kind of CDO marketplace that we established back in '04 to '06, and the visuality of it for I think most people was the fact that houses went up all over the place, and people who had, you know, were making $50,000 a year were getting, you know, no doc loans for $500,000, and that was kind of how it all played out.
So that's right. You can see that in the financing numbers. You can see that also in that vacancies started to creep up as you had pretty rampant speculation leading to people who had, you know, short-term plans to flip homes. And the good news is I think we've finally unwound most of the problems that were created by that.
So just from a historical perspective, as an economist, does it make you worried that we're in the 8th year of a recovery? And shouldn't we be thinking about another recession at this point?
Yes, yes and no. If you look at long-term trends and the definition that we've been in a recovery for 8 years, but as I mentioned before, this hasn't exactly been a normal recovery. And you can see that, you know, for example, I would argue that this is the first year that the housing market has been healthy since, you know, I've been pointing back to 2006, but you can argue that 2006 certainly wasn't healthy either.
No.
So I think some elements of the recovery are just now getting real and getting fundamental. And another way to kind of put it is that it's also the challenge that the Fed has been facing with regards to when is the appropriate time to come off of a zero interest rate policy. And that has been, it's been really what has been referred to as a Goldilocks type of recovery, meaning we weren't ever getting hot. You know, 3% is something that we're excited about these days.
And what does that say? 3% growth, and people are like putting up balloons.
That's right. That's right. And I think maybe 20 years from now, 10 years from now, we might have enough information to really realize that we're going through a major structural period where so many things were changing. Globalization has certainly impacted labor, and it's caused the U.S. labor to essentially have to be far more competitive, and as a result, wages and incomes haven't increased for quite some time. Technology went through a tremendous productivity cycle, and now it appears that productivity has slowed again. And then meanwhile, we've got these enormous demographic shifts occurring in the country, you know, such that virtually every developed country in the world is seeing only growth in one category of households, and that is households that are retired or over 55, over 65, or et cetera. So we're really going through a lot of fundamental changes that I think eventually will make sense when we have more data points to look at. But back to your original question about the recovery, at least from a housing perspective, I don't really see too many risks over at least the next year or two, which of course is where we have the most visibility. Because again, it's fundamental health, the kind of factors that lead to price weakness or declines in the future are just not present. We really have fundamental health for the first time in a long time.
So the studies that you've just done for Realtor.com, top 3 hottest metros for July in terms of sales and probably price increases as well. You've got San Francisco, Denver, and Dallas. 11 of the 20 hottest markets are in California. I was just in San Francisco, and my son's friend, who's got a job out there for the summer, is making a ridiculous amount of money per month. He's working for a big hot tech company. They're paying like $8,000 a month. His rent, $7,000 a month. Now he's got 4 guys sharing that room, that 2-bedroom, but the point is that it's still $7,000 a month for a tiny 2-bedroom in San Francisco. You know, what is that saying about where we're going?
Well, so the story in California is very much what you just described. It's really been following phenomenal economic growth And the nature of that economic growth, largely driven by the tech sector, has been producing significant increases in the number of high-income households. So just to frame it, the entire state of California, which of course is a could stand, I think, as the fifth largest economy in the world if it were independent. So there's quite a bit of variety. But over the last 15 years, California has had an increase of households to the tune of 14%. But yet the number of households that make over $200,000 a year has more than doubled over that period. So the nature of the growth they've experienced has essentially created demand for housing that can afford the kind of prices that are there, both on the rent side and the owning side. And at the same time, it's incredibly difficult to increase the housing stock in California. Land is extremely expensive, has been. Plus, the regulatory environment makes it one of the most difficult places in the country to entitle and develop land. And so as a result, you essentially have a housing shortage that by day is getting worse and worse, and the market responds to that with higher prices, and the households that are there increasingly are capable of paying those numbers. So it hasn't been a surprise. We've been ranking the markets every month this spring and summer, and the California markets have dominated the list because largely of the growth in the Silicon Valley and the Bay Area, but also now Southern California. And there's quite a bit of spillover effect. That's the word that I've used to describe it, because number one, you have the situation that households in Sacramento and places like Stockton are willing to commute more than an hour to be able to afford more of the home that they expected and wanted to live. And at the same time, you have an economic spillover effect that, California is in a virtuous economic cycle, that the housing, what's going on in housing, both in new construction and home sales is supporting economic growth, and in turn, that's driving more demand for housing. So there's no question that California has great mojo. But as you pointed out, it's not just California. We've actually been watching San Francisco, Denver, and Dallas duke it out each month for which market is going to be the absolute hottest in the country with regards to how fast inventory is moving and how many eyeballs are looking at the listings each month.
Well, I have to just say, but some of your other top 20 lists, I was amazed. Ann Arbor, Michigan, from the University of Michigan. I was just there. My son is touring. Very interesting what's going on. A lot of things there that are very tech-driven out of the university that are starting to build their own kind of tech, science, medical communities. Just a lot of demand there. Detroit, we've seen property prices double from, like, say, $500 to well over $1,000 for that 6-bedroom house. No, I'm just kidding. But you know what I mean. It's not. Detroit is coming back, and we've done stories ourselves for a bunch of our different outlets about how property was bought, big, huge houses for, maybe $10,000 or $18,000, and those same homes now are selling for $200,000. They've been fixed up, and the neighborhoods are starting to slowly come back. Columbus was interesting. I was just in Columbus, and there's just a little bit of stuff happening downtown. It's really, really interesting. The neighborhoods, they have a real problem, though, with taxes and school districts. Austin, of course, university-driven, and then Los Angeles. Any surprises here to you?
Oh, I love that mix. I love seeing some Midwestern markets show up in the list. Austin, to me, is not so much as interesting as Detroit, Ann Arbor, and Columbus, because Austin is very much like another Denver, essentially. It's a story of the same thing going on in Northern California, if not driven by the ridiculousness of what's going on in Northern California.
Wait, I have to tell you a story about Columbus. So we're there for my son was playing in the Volleyball Nationals, and they were held in Columbus this summer. So we were just there over July 4th. And we were hanging out with a guy and his wife. This was my husband's best man at his wedding, a college friend. His wife's, she works as a secretary at the local school district outside of Columbus, a nearby suburb, really fancy suburb. And she tells me that all of the teachers have taken second jobs as realtors. and they are selling real estate after school and at downtown, because the downtown of Columbus has gotten so hot with all these shops and the live near work kind of thing, that she said everybody there, they think they're going to be fired from their school teacher jobs because there's no money for schools because of tax reform. So they're all buying and helping people buy and sell real estate.
Well, maybe that explains a little bit of the demand that we see, but you know, it's interesting, both Columbus and Detroit also made the list that we put out yesterday on the easiest places to buy in the country. So it's interesting to look at those two markets because they made both of our lists. The newest report that we put out yesterday on the easiest places to buy. And that's testament to the fact that when we did that list, we were not identifying, you know, the ultimate buyer's markets in the country from the perspective of unhealthy places. These are places that are still seeing inventory move faster than the national average, and are also seeing price increases. But it represents that some of the demand that's going on is quite simply as people are looking for affordable places to own a home. And those markets are also places where you're seeing much larger numbers of millennials, the younger households, which we think are absolutely what's driving the real growth that we're seeing in housing this year over last year.
Well, let me just run down that list very quickly for everybody. Indianapolis is #1, easiest place to buy. Memphis, Virginia Beach, Birmingham, Alabama, Cincinnati, Pittsburgh, Atlanta, which is really interesting. You'd think everything had been bought there by now, but no. Cleveland, Detroit, again, Detroit to your point, and Columbus, Ohio, also to your point. All of that in the eastern half of the country and a little bit south. Not super far south. We're not seeing Florida. We're not seeing really Texas in there. But the eastern, kind of the eastern, I don't know what you would call, mid-Atlantic. What do we call that now?
It's pretty much the Southeastern Conference.
Southeastern Conference. There you go. Just go to sports. When all else fails, there's a sports metaphor. Jonathan, we're going to put up links to all of these so people can read everything that you've written, but I would love to have you back. This was, as I thought, a really terrific conversation.
Yeah, anytime, Ilyce.
All right, thank you. Jonathan Smoke, Chief Economist for Realtor.com. Thank you for watching this episode of Big Money Real Estate. We went a little bit long, but, you know, I figure if I'm interested, you might be too, hopefully. As always, send me your real estate investing questions on Twitter and Facebook. Please share this video on social media, and we will do the same. See you next time. I'm Ilyce Glink.